Thank you, everybody, for joining us. My name is Max Chera. I'm from Express Capital Financing. We have Paul Viguerie here with us as well from Hubzu and Altisource. Today's conversation, really, we're going to be talking about the SFR space, the single family residences, obviously for investment purposes. We're going to get into the numbers. We're going to get into talking about it and is it a good investment in today's market, what the trends are looking like, how to find properties, and how to finance them using private money. Paul, we were kind of just talking a little bit and about the numbers, and there was some interesting facts, I guess, that you wanted to highlight, and I guess I'll give you a moment just to talk about it. We could talk about it a little bit.
Sure. So I'll first introduce myself. I'm Paul Viguerie. I work for Hubzu, which is our online marketplace owned by Altisource. And we auction real estate. And we've been doing this since 2009, and we've sold over 280,000 homes. So we've been doing it for a while. It's a great place to both sell real estate, but also to purchase real estate. And we thought, Max and I thought that joining together on a webinar and really bringing this back to basics. This is going to be we're going to try to keep this conversation as simple as possible, and really try to provide as much assistance and help in how to get started purchasing your first or second investment property. And so, and the, it's there's a specific reason for why we've chosen to do this and produce this content. And by and large, it's because that is real estate investing. Real estate investing is still a mom and pop industry. And there's some stats that suggest that the that it's not an institutional ownership play, despite some sensational articles that are written in newspapers about BlackRock or big hedge funds. But it looks like it's still mid 80s. It could be as high as 87% or maybe low as 83% of single family rentals, SFR, are owned by mom and pop. And that is expressed by people owning a handful of properties or less. So so that is who buys real estate primarily. And it's changing. That needle is shifting a little bit. We have a lot of data on aggregates and how much real estate is purchased each year. And so we know from the National Association of Realtors that 4 million-ish homes were sold last year. But we have additional data to suggest that there was another 700,000 or upwards of 1 million homes that were sold last year, primarily to cash buyers, which is the investment community by and large. Those are buyers, and being a cash buyer doesn't mean that you have all the cash. By knowing Max, you're able to make a cash offer. And so that is the investment community by and large. They make cash offers on properties to be competitive when they're trying to buy a property. But again, as that 20% remains very consistent, the number of mom and pops will shrink a little bit. It'll probably keep dipping, but we are seeing a new emerging trend where it's not just the parents, it's many people in their 20s that are showing up, purchasing a property as an investment prior to even purchasing a property to live in. And that's curious, but they'll buy their first property and then they create some cash flow and then they maybe get their second property and suddenly they're in the real estate game and they're not yet homeowners themselves. It's radical, but that's what is happening on, in within this ecosystem.
I mean, we see that more and more, and like I guess it really depends on which guru you're going to listen to when it comes to real estate, right? Do you buy your primary home first? Do you invest first into a property? And I can't help but feel that they're actually doing it right, right? Buying an investment property first is actually what's going to create you more cash flow. It's actually you're putting your money now into an asset versus a liability, right? Because your primary home at the end of the day is a cost to live, right? You're not benefiting out of any sort of cash flow from it. You're saving yourself, people will look at it and say, well, I'm not putting my money into somebody else's pocket, I'm putting it into my own pocket. But if you take, and I'm going to give myself as an example, right? I live in Brooklyn, New York, where if you want to buy a single family home to live in, you have to spend a million plus, right? And you're probably not even going to qualify, for FHA because of the loan amounts. You're probably going to have to end up putting down 20%. So with the amount of money, the liquidity that you have, if somebody were to take those funds and put it into two or three properties in a different city where they can actually get something more affordable, where rents are going to be a little bit stronger for them, they can actually make their rent payment plus more if they bought investment properties, right? So it's just showing more and more that, people are getting smarter. Back in the day, you know, when it, you talked about our grandparents and their grandparents, like the ones that bought real estate were the smart ones, and everyone sort of learned from it. Real estate has a lot of shiny stars and spangled banners around it, where it's like, hey, get rich quick is real estate. Well, no, it's not get rich quick, but it is extremely successful, right? Most successful people have a real estate background, and most people that are successful, if they came from a different space, they will invest into real estate. They understand that it's a solid investment for, holding their value as well as also being able to create cash flow out of it. So we're seeing now that more and more people are getting smarter and ahead of the curve, and your everyday mom and pops are getting involved, and they are going ahead and buying a single family in their neighborhood where they can create generational wealth out of it, pass something down to their kids. So we're here to really bring more of this information, showing you how it's possible. How do I get involved? Maybe I don't have $300,000 cash, but how do I go ahead and buy a property all cash? Where do I find the right properties? These are all things that are possible out there for everybody in every market. It's just a matter of having the right tools, knowing where to go to find the right properties, and anything is possible.
And I'd like to also add that we'll talk about different strategies today, and there's always the allure of the fast buck, especially when it comes to real estate, because those are sensational stories. However, with real estate, nothing succeeds like time, and it's true. And if you were to look at those that have become successful investors essentially anywhere in stock market or otherwise, you'll hear strategies like buy and hold. It doesn't even sound like a strategy. It's just called buy. But in real estate, it's true too. This is something that is not historically a volatile instrument that appreciates. Which there's ways of using debt that's intelligent, and then there's the type of debt that is you don't want to have, like credit card debt, obviously. But real estate debt, if it's done correctly, can enhance a return beyond just holding real estate in a manner that where it's paid off. And Max can talk about that a little bit, how to amplify the return side of the equation while minimizing the risk in an intelligent fashion so that real estate is working more efficiently for you.
Yeah, I mean, so when it comes to minimizing risk and finding ways to get it, I think something that everyone also has to think about is who they are and what they have available to them at that moment, right? So, for example, one of the big strategies, like you said, right, the buy and hold strategy is very simple, right? You buy it and you hope that it stays well and it keeps giving you a return, and it works most of the time, right? The idea behind it, and I think it was Warren Buffett that said this: when to buy real estate is when you could afford it.
Yeah.
Now, he doesn't just mean that you could afford to buy the property. He also means that you could afford to actually hold on to it. So what that means is that should there be a HVAC issue, should you need to do some repairs, you're able to do that and not have to give up the property by any means necessary. You're not going to get put into a situation where your back's against the wall and you're forced to sell it. Why do I mention that? Because it's all a matter of the timeline, right? If I bought real estate, in the 70s and even during the 2007 dip, was I still probably ahead? There's a good chance that I was, right? So just because a price dips from where it was doesn't mean necessarily that I took a loss on it. Now, if I bought it in '05 and I was forced to sell it in '07, then yes, I took a loss, right? So it all depends on when you bought it, when you're selling it, as far as did it go up or did it go down. So you have to understand the timeline and make sure that you're capable of holding on to the property. In addition, the next thing that I want to go into is, a really big, strategy that's becoming more and more common, more and more famous. It's known as the BRRRR strategy, right? People are buying, they're renovating a property, so they're buying something at a really good discount because they're getting a discount on it because it's not in the greatest condition. They're providing and adding value to the property right away. And then what they're doing is going ahead and renting it out and refinancing it into a long-term debt, right? They have to do that strategy because they can't get the long-term debt when they bought the property, nor do they want to be able to upfront the cost for a lot of it for the renovation. So they're able to get that from private lending. So what that does is, number one, is it minimizes the amount of skin in the game that they actually have. Now, most of us lenders want them to have some skin in the game, which is why you'll see there is a down payment still of 10 to 20% of the purchase price. Why do I mention of the purchase price? Because you're still getting the renovation money on top of it to put into the property. And when we're underwriting it, we're looking at, okay, well, what are you actually going to be able to, what is this property going to value at? Are you going to be able to refinance and actually get us paid off based off the equity in the deal? And if the answer is that you can, well, now we're going to say, okay, well, can it actually afford the mortgage that it's taking, right? We're not looking at the John or Jack's, 1099 or their W-2 or tax returns to see if they could afford the payments. We're looking at the actual property, right? Because we're looking at this as this is the deal. This is what is paying us. And if this doesn't provide, well, then it's going to come out of your pocket. So at the end of the day, a lot of the underwriting strategies that lenders have taken are now geared more towards making sure that the actual deal makes sense, that you're going to be in a good position. Not only does the deal have to make sense, but we add a little buffer. We don't want you to be at we use a ratio. It's called the DSCR ratio, right? So the amount of income that the property is receiving versus the debt that it has to pay every month. So just to give very, very simple numbers, if you have a property that has $1,000 is the principal, interest, taxes, and insurance payment, right? So you're PITI, and you're receiving $1,200 a month in rent, you're at a 1.2 DSCR. So with that being said, we're adding in a buffer so that there's also availability for, number one, cash flow, but number two, also the ability that if something should come up, the property could afford to pay for those repairs or whatever it may be. These are, a lot of the risks that you mentioned, Paul, I guess that people have to take into account are they're being thought through by your lender, right? Your lender is actually more concerned with this property making sense than the buyer is. They have more skin in the deal than the buyer does most of the time. So we want to make sure that the deal is going to make sense, that the deal could afford itself, that there is actually a cash flow for you to receive before getting into it. Now, could everybody do the BRRRR strategy? The answer is yes, but no, right? Everybody is capable, but number one, finding the right property is usually a hurdle, right? Finding something that there is a room for appreciation just by doing immediate work. And number two, I would say, is time, right? If you are a really busy guy and you have capital to invest, but you don't have the time to watch over your contractors, make sure they're doing the right work, making sure that the deal is progressing as it needs to, it's probably going to be pretty difficult and you're going to incur some delays, and delays lead to losses. Now, if you have that time and this is your full time, go for it. That's where you're going to find a lot of your profits, right? But again, that first person could still invest. He still has the ability to hire a property manager and make sure that they're looking after their properties and do the buy and hold strategy. So what it really comes down to is I think is looking within and thinking to yourself, all right, what capacity do I have to put into this? What kind of time do I have? What kind of capital do I have? And who's the team that I have behind me to ensure that this is going to be a successful transaction?
I like that. And there are a couple of points I'd like to make that feed into the burst strategy that you mentioned. Um, to start, the average housing stock across this country is 40 years old at this point, and it is not updated. And there is a need to make these houses current. And so, and clearly, a house that has been renovated is worth more than an unrenovated home. And there is a buffer of safety in renovating a home. You've got to control costs, certainly, and be wise and prudent. But there's a overall supply-demand imbalance with housing in the United States, and it's estimated that there are 5 million too few homes right now. That 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 if there were an additional 5 million homes, uh, well, then it would be balanced out. And ironically, it seems though many of the kind of the short-term rentals, vacation rentals, has 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 kind of sucked that supply. Were those converted back into homes for people to live in, and to some degree that probably is going to happen, then things would be more balanced. And so it's not fair to say that 5 million homes is a true number, but because there's a carve out that suggests that these vacation rentals have um, you know, taken up some of the supply. But but it is a good strategy if it's possible to still renovate because there's an opportunity to, amortize that cost over a longer period of time. And then again, back to nothing succeeds like time, build wealth over decades.
Yeah. And
And then it should be noted that while we're talking about homes, a house that one would live in, when you work with Max or Express, it's still underwritten as it's not commercial, but it has to make sense financially speaking, uh, from a rental perspective, in order to underwrite the property. So it's the same kind of metrics that go into a big skyscraper when he's trying to make sure that it works.
yeah, it's always about the profitability of the deal. And, one thing that I'd like to also add on top of what you mentioned, right? So we're right now we're in a shortage of houses, right? On top of that, rates also went up. Well, let's use post-COVID, right? So since COVID, rates have raised, right? They've gone up, and that actually limited the affordability of properties. Because here's another interesting thing. Generally, when rates go up, house prices come down. Now, we've also had call it an inflation problem, or just the concept of inflation has been there, where property values have not come down as much as they should based off of how much higher the interest rates have gotten. So what happens is now that there's just less people that are capable of affording, right? Whatever that number is, whether it's 10% of a market could afford to buy a home in that area, now it went down to 9, 8, or 7. There's just less and less people that can do that. And what that caused was also is now the value of single family rentals to go up because now they're getting more rents because there's more competitors for renters in that market. So it's a really interesting thing how it's a domino effect of one thing to the next, which causes, a series of events. But at the end of the day, there's a reason why the single family rental space is doing really well. Everyone has their eyes on it, and for a very good reason. Even compared to, and I guess you can say, most people would say they understand this without even any previous thought process, but like rents right now are higher for a single family rental versus renting a multifamily apartment, right? I get it, right? You have the more privacy and all that kind of stuff. So it makes sense that somebody would be willing to pay that. but we're seeing that it's gone up over time. And again, these are Zillow's numbers that they're putting out there, where it's increased by over 41% since the pre-pandemic for since pre-pandemic. So there's a lot of demand for it right now. And right now we see that it's a good time to get in, right? It's a good time still to be able to find the right properties and working with, Hubzu, being able to find the right properties at the right price, right? Because just because it's a good market doesn't mean you have to buy it at the highest price possible, right? So, at the end of the day, like I said, it's all about the buy, really, if you think about it, right? And when you sell it or when you're looking to exit. But the buy is really important. Just because, you know, things are flying through the roof doesn't mean I have to pay top dollar. So finding ways to find the right properties at the right price is also really important. And having ability to look through properties, whether they're REOs, whether they're under foreclosure, whether they're being done by a wholesaler because the seller needs to sell really quickly. These are all reasons that somebody would take a little bit of a discount on their property value. They're trying to offload it. They're worried about getting it off their books as quickly as possible, right? Somebody who needs to move out of state and they have a month to do so may not be able to go to the market and get top dollar for their property. They're looking for somebody that's going to be able to come and close quickly. And that's where, how you finance it and how quickly you're able to move on it is going to get you the right deal.
Very true. And so if you think about how many properties are for sale through the MLS, and they're typically connected to a broker, an agent, and that is the traditional model. And we've diversified at Hubzu over the past few years, in part out of necessity. But I think it's important to note that there's a couple of different primarily categories to consider when it comes to real estate. There's the involuntary sale, which is a property that's experienced some version of default, and then there's the voluntary sale. And so the background of Hubzu and where how it how it succeeded and grew to where it is today, where we, as I've mentioned, we've sold 280,000 homes, and we now have 2.6 million buyers on the platform. We still are primarily selling to investors. We know that 80% of our buyers pay cash, which is indicative of an investor. And so while we have different categories of real estate on the platform, like right now we have 1,680 properties when I checked this morning. This is a very good place to look to get a good deal. Now, we sell retail properties today, and maybe those properties can also be good deals, and they are, placed on our platform by a retail broker, and they are on the MLS, and maybe they don't require that high level of renovation for Burr, and maybe they end up being more attractive if you're looking to get started quickly and convert a property into a rental right away. But maybe we do go to the platform and kind of show
Yeah,
the community how one would even register, and then what type of properties you would look for.
I think so. You should take it away. If you want to do a screen share,
Yeah,
we could walk them through it and even show them the different type of property sales that are available so that they understand, the differences between them and how they can start bidding.
great. And then maybe after we've shared Hubzu, I would really like to show on your site how some of the investment calculators could be used to in conjunction with the platform. So when you're looking at these properties, it's great. It's a house, there's a price, there's a now I'm not getting I'm trying to can you allow me to share the screen?
Yes. I thought I just did, but I'll do it again.
but you'll ultimately
See
end
if
up
that
working
works.
with Max and his investment calculators to make sure that it's a good investment, and that can be very helpful.
100%. I mean, one thing I'd like to say while you're getting that pulled up is that when it comes to using a calculator, right, your math is only as good as your numbers are. So it's important to really, understand, what you're putting in there, where everything's coming from, knowing that the information's valid, having the right team behind you that can help you find the information even that you're looking for. So, we'll show you how it all works. And Paul, take it away with the showing us where we go to register and how to find properties.
Great. So there's an interesting mentality when someone purchases a property on Hubzu. Um, and I know this because I've met so many people who have bought properties on Hubzu. And when they do, they always uniformly say, I want a property on Hubzu. So it's competitive. There are other people buying these properties, and it's an auction, and therefore people are bidding on these properties. And we run 7-day auctions. And so with any given property on the platform, we will run a 7-day auction and there will be several buyers competing for that property. That doesn't need to be scary. It's just how we sell real estate. But it's very important to walk in before I dive into the platform to walk in with a disciplined game plan that you don't want to get emotional and overbid on an investment property because then while it might be the best property in the world, if your entry price is wrong, it changes the investment prospects of that SFR. So that said, and I won't go through the registration process, it's very simple and intuitive, but the first step would be become a registered user, which occurs by pressing this button at the top right, register, sign in, and it walks you in to becoming uh, a, a registered user. There is no subscription fee, so it doesn't cost money to be a registered user. Now, in order to bid on a property, there is a bid deposit. We need to make sure that anyone attempting to purchase a property on our platform has some skin in the game. We need to make sure that there's a very high likelihood that the buyer actually intends to purchase the property, and that's just good business. Um, so we sell properties all across the country, plus the territories. And so we've designed the platform to be very simple. So we have a buy button, and then it contains a few subcategories, but one could click on all real estate. That would bring up 1,680 uh, pieces of properties that are for sale, all in one stage or another of a 7-day auction cycle. Then, as I mentioned earlier, real estate can be divided into two segments, involuntary sales and voluntary sales. And so, an involuntary sale is more likely to be a distressed property, and therefore, perhaps there might be a better deal associated with it. Would you agree, Mike? I mean, Max?
Absolutely. In the end of the day, the more motivation there is behind the sale, the better of a deal you're going to get. And that's, by the way, something that we should always look for is the motivation behind the sale.
So, when real estate goes into foreclosure, and doesn't sell, and typically it doesn't sell, and there may be a reason why it didn't sell, but investors are all looking at these properties and while they're in foreclosure, and then if a bank or a servicer did not sell that property in foreclosure, it becomes bank owned, and it the term is often used is REO, which stands for real estate owned. And and so these become bank-owned properties. Now it's sitting on a balance sheet. It's often costing the banker servicer money. They did not want to own these properties in the first place. This is not the business they signed up for, but they still need to sell them and get them off of their, for them it's a balance sheet item, for you it's a home. And our mutual friend that we've both worked with in the past says one house is a lot of houses. And so I think that that's an important concept when trying to buy an investment property. So when a property is in bank owned, it it's already passed in front of a lot of buyers that are sophisticated buyers. So it's not a buyer beware, but it's be aware of what you're entering into. And so with this type of property, it makes sense to probably see it, walk it, uh, perhaps work with an agent. We can recommend many agents that can help you make an informed decision about the physical aspect of that property, and then really make sure that it's underwritten correctly so that if it does need repairs, and many do need repairs. But if it does need repairs, that you're not overpaying for that property. We need to make sure that there's a a spread or margin that can still be earned if you turned around and sold that property. And while I started by saying nothing succeeds like time, I do feel that that might end up being the strategy. Perhaps you follow the Burr strategy and you rent it out, but you should never overpay. You should be able to turn around and sell that property and make money on day one. Otherwise, I would not buy that property. Not that you should sell it on day one, but you should be able to. So control your entry price so that it allows for a margin of safety. So the next segment is our retail Hubzu signature homes. These are homes that are often purchased by owner occupants, and we have 700,000 agents on our platform helping people buy homes. But they can make fantastic investments because a lot of the brokers that we work with that put the properties on the platform send properties that are great for the type of buyers that we have on the platform. So, signature homes, while they are on the MLS, they are retail. They should not be overlooked by an investor because you can still find a good deal on these properties, and it's definitely worth bidding on them. Many people that send properties to our platform are looking to sell their properties quickly, and that's one of the incentives for using Hubzu. Um,
If I could
we
just
Go
if I could
ahead.
just add one thing on that, by the way, which is there is a lot more potential in that space than people seem to think. Sometimes, being on the forefront on that side of the deal where you're representing sellers and selling their home, I can tell you that countless times a seller was a little bit emotional and would put a price that may have not been realistic with the market. And what would happen was is people would be hesitant to put an offer on it. Eventually, when somebody comes around and says, "Look, I'll offer what it's worth," and they give an offer that maybe even it's a little bit below the actual market value of the property, that seller now sees one offer that they haven't seen in a very long time. So, or you might just have a deal that actually really works well in that market. There are some markets that are just made for rentals. They rent really, really well, and the comparables in that market really fit within the price range where it makes sense. So you'll see a lot of different scenarios that'll actually work out for investors, and I would not neglect them.
Yeah. And then thank you, Max. This next category, off-market properties. People have heard of pocket listings, or this is many investors gravitate toward these properties, and they're often connected to the wholesale community. And uh, with these properties, it's still a voluntary sale, but you may have somebody needing to move or and doesn't have the time to list that property with a broker and trying to get top dollar. And or it could be a vacant property. For one reason or another, the owner of that property wants to move the property and sell it and doesn't have a use for it, and it's or they may not feel like putting the money into renovating it to find a buyer, and then it's more likely that it will sell to an investor anyway. And so that the owner of the property doesn't put the capital back in and just chooses to sell it to an investor. They tend to be quicker sales. It could be a more competitive bidding environment because you're buying a what should be a very attractive investment, but there's only a narrow window of time that these sellers are willing to work with investors. So they may give them 3 or 4 weeks to sell this property, but it's still a great category to look at and try to find a good deal. Here are foreclosure properties. We don't see short sales as much anymore simply because of the amount of price appreciation we've seen in the last few years. A short sale is typically when the house is sold is worth less than the debt. So there's negative equity on and these types of sales. And then we have the traditional sale. Right now, Max, I'm going to go straight to our bank-owned properties and describe a strategy that works for a client of mine. And what he does is waits until it's been in a bank-owned situation for several months, hasn't gotten a lot of bids, and then he will try to scoop it up at a lower price. And been very successful then renovating those properties and then turning around and selling them in the retail channel, which is Hubzu Signature Homes. And so it's interesting to buy neglected
And so,
properties and then the 40-year-old that property that needs renovation, show it some love, and then turn around and he finds agents in a location that are very successful. And then he says, I'll work with you if on the backside, but you're going to have to help me find a contractor. And, maybe you end up doing some of the property management, to make or oversee the construction so that it works out well for him. And, there's an incentive to get that house to the other side of renovation so it can be sold again. And then the agent can earn a commission. So let me pull that up.
please do. And while you are, you mentioned something else earlier, which resonated, which was, when you're buying a property, even if your exit strategy is to sell it, make sure that you're still able to, I'm sorry, if your exit strategy is to rent it and hold it, make sure that you can sell it if you need to. That really resonates well just because, no matter which way the market turns or moves, you have two exit strategies. You have two ways of creating a profit off of the deal. And again, when we see that as lenders, we get excited about those because it means that one way or another, whether the person is capable or wants to hold it, they can. And if they're unable to, no problem. At least there's still a way to exit the deal. Even times where properties have appraised for the right ARV, and it just so happens that that market at that time, specific time, couldn't sell it for the price that they wanted to, knowing that they were able to still refinance and hold on to it, not take a loss, wait for a better day. We've seen deals like that have a far more highly likelihood of success.
Couldn't agree more. So with the map on the right, you'll see that they're spread. These properties are spread out across the country, and there are over 1,000 properties in this category. So that that's a lot of homes, and most, especially in the very beginning when they're buying their first property, do try to purchase properties that are close to them. So, in real estate, they say location, location, location. But many people want it in their location. And so I even see this button nearby properties. So people people tend to initially purchase a home near where they live so that maybe they can do a lot of the property management themselves. It's always possible to hire a property manager, and typically what occurs there is that there's a percentage of that rent that is paid to the property manager for that oversight. But I'll scroll through some of these properties, and you can see that bidding is occurring. There's a number of hours and minutes before that 7-day auction expires. Uh, it's funny, you can find a property that has been on the platform through a few cycles, and then one bid comes in, and then it's a bidding war. And it's a little bit like I think I like to fish, and I've been on fishing trips where you don't get a bite, or you don't get a bite all day, and then you get one bite, and then the fish explode, and you're in a school of fish, and it's nonstop. So it's funny, the competitive spirit kicks in at some point, and you just don't know when it is. Um, I would caution against a bidding war. Um, Somebody is going to lose their head in that process, and in all likelihood overpay. Um, but you know that sometimes they want the property, and they could have a higher use case for that property too. So
Yeah, and just if I could add a little bit to, something you mentioned earlier about the nearby properties. Another big advantage to buying properties near you is that you know that neighborhood better than most. You
yeah,
know what your neighbor, what kind of finishes they have. So when you see a property on your block or on the block and you can see it, you could already know, oh, they sold it for 500,000, but this one has much higher quality kitchen cabinets. It's more spacious, the layout's even a little bit better. You're actually using real comps and coming in from a position of information that most people may not have, right? Because sometimes even when I'm trying to run comps, like I'm looking at properties and I'm seeing just the outside of them because they took down the inside pictures or whatever the case may be. So it's always good to be in your backyard. Now, sometimes your backyard may not be the best investment market, and that's okay, right? Look a little bit, you don't got to go too far. Everywhere nearby, there's always going to be a good place to buy and invest. You know,
very
don't get
true.
caught up. It's funny because we see a lot of like the trends when they come out, and we'll even write blogs about them, like, oh, this city is now the best place to purchase property in, and or this market over here is seeing such a big increase in rents. What ends up happening when people follow that and they're coming in from far away is that you see that it just creates so much traffic that in the end of the day, like how long until people are willing to overbid me to where that price now is not worth it anymore. So kind of going back to even what you said earlier about the don't get into a bidding war, it's like, yeah, when you see that there's too much action somewhere, sometimes you got to know your place. Sometimes you got to realize, hey, this is already going further than it needs to. Don't be emotional. This is a logical decision, not an emotional decision. We're not living in these homes. Anytime that I've even come across a deal from an investor and we're talking about it, and I can tell there's emotion behind it. I can tell that they're trying to make a deal work that would never work. And I'll ask a couple of questions and find out, well, actually, yeah, this was my mom's house, 20 years ago, and I was born here, and that's why I want it. But if it doesn't make sense as an investment, it just doesn't, right? I understand why somebody may want it, no problem. If you were willing to take on that liability, you would just have to find another method of doing so. But at the same time, we're here to invest to create cash flow. We're here to invest to find deals that are going to appreciate. We're here to make our money work for us, not to overspend that hard. Again, most of us work really, really hard for that money. I don't think the numbers are too slim to say that we have somebody here that won the lottery, but we all work really hard for that money. Don't let it go to waste. Find the right deal. Find something that's actually going to produce what you're looking for out of it, and trust me, all you got to do is look. It's okay. Don't feel bad. Have a little bit of thick skin. If one deal you went to it, see it 3 times. You made the offer, you got the contractor, and you found that there was something else behind the walls that just wouldn't make it profitable anymore. It's okay. You could always either renegotiate or walk away. You don't have to take it all the way down and find out that, a couple years later, now I got to figure out a way to get out of this.
Very true. Fall in love with people, not property. You
I
you
like
fall in
that
love
one.
with a piece of property and then you're going to find yourself with a bad entry price. And it's just not worth it. There's another train coming through the station. We have 1,680 properties. If you miss all 1,680 properties in this cycle, there will be another 1,680 properties coming. And then there's there is always a deal to be had if you're patient. Yeah,
Patience is key.
you have probability, reward, and people don't like to talk about it, risk. And if you manage those three things correctly, you'll win.
Agreed. And just to kind of play the other side of this double-edged sword, right? Don't be afraid to take action either, right? Don't be a deer in the headlights just
No.
because, the word risk came up, right? It's imperative there's always going to be a risk no matter what deal you do, no matter how secure somebody tells you it is. There's always a little bit of risk or a lot of risk depending on, what it is. But at the end of the day, it's part of the process. you know, Look to understand them, what the risks are, mitigate them, put certain things into place in order so that you ensure that those risks are not a liability. And at the end of the day, you got to move forward with it. You got to put your head to the work. You got to put yourself to work, make it happen. So don't be too much on either side of the spectrum, right? It's a seesaw. You go too much to the left, you're going to fall left. You go too much to the right, you're going to fall behind and never make a transaction.
And also, bidding is important. Many people think that just because they bid, they're going to win that property. That's not the case. It's going to take so many at bats to win a property. And so, if you're waiting for that perfect pitch, I honestly don't even know if there is a perfect pitch. You're better off being involved. And so this is a smaller list. These are our retail properties, and in all likelihood, you can work with an agent to purchase one of these properties, but they still can represent great investments. And I see some lower starting bids. So, don't overlook this segment of our platform. Some attractive properties too, and so place a bid. You can't begin to buy a property without placing a bid. And you're going to probably need to place quite a few bids before you purchase a property. So it's not the scary moment to place a bid, but work with Max, talk to Max. What do you think this property, what does our entry price need to be to make it profitable? And it's it's just math. And I know math can be scary, but that's where investment calculators can be very helpful. And there are ways of getting AVMs, which is a version of valuation that's automated to come up with estimates. And if you're working with an agent as well, I think an experienced agent in that location, that can be very valuable too. So consider that you're not alone. You have a team in place. You're going to be working with your team to secure your investment property, and you have maybe Max more on the financial side. You have your agent with these properties that are the boots on the ground. They're seasoned and have seen it all, and so everyone is
One
here to help
person can't
support
do
you.
it all. Yep.
Yeah.
Not one person could do it all. Everyone needs to rely on their team. Whether you're running a family, everyone does their part. In a business, you have cashiers, you have salespeople, you have stock people, right? The business can't run without that, the same way your real estate can't run without it. Make sure you have the right people in place. And when it comes to, looking at these deals and trying to find valuations, number one, yes, get familiar with your market, right? You should not be, you should not be on this website and this is your first time thinking of real estate and just going out and putting in bids. That's not the right way to go about it, right? If you identify your market, identify what it is that you're looking for. Where do I want to be? Where do I believe, which market do I believe in? Then go ahead and start to research that market, understand it. What are values going for? What are properties selling for? Why are ranches selling for more than the Tudor homes in this area? Why is that a thing here? Understand it so that now when you're looking at these properties, because right now everyone's looking at these, and let's just take for example right here, we see a property in Fort McCoy for 129,000, and below that I see a property in Detroit for 20,000, right? Ooh, that deal is really good in Detroit. It's 20,000 because I'm comparing it to a property for 130 in a completely different market, right? We can't get caught up in that. So we truly have to do research to know what it is that we're looking for and identify it. I'm looking for a single family. I want to be in an area as such where I could get X amount in rent, and I want to be able to, and look, there's classes of neighborhoods. You have A class, you have a B class, C class, and so on and so forth, right? Understand what it is that you're looking for. Know that, hey, if I'm in an A class, what are the cons of that? If a repair comes up, it's going to be more expensive because they're expecting more. Versus C class, maybe I have to, have someone help me with the management. So there is there's pros and cons to everything. You have to kind of understand what they are, and for lack of a better word, pick your poison, pick what you're willing to deal with, pick what you're willing to work with, and you can start to find and identify things a lot easier. You can understand now when you look at one, you're going to say, "Oh, that's a deal." Um, on that
I,
note, also, go ahead.
oh, well, I'd say every location's different in and the corresponding pricing can be very confusing, Detroit versus Florida. And then also, while a picture is worth 1,000 words, the best pictures tend to attract higher pricing. My most experienced buyer I've worked with came across graffiti on one of the pictures and said, "Yes, I love it when I see graffiti because I'm going to get a good deal." So all of the things that you think it can be kind of inverted at times. And I say it somewhat jokingly because clearly with this property, I see a little work ahead, but the pictures are not getting me too excited about like I see a project, but also this is Florida. Florida's tended to be a good market, and these properties, these are the highly motivated sellers that are willing to sell to an investor, and so there should be an implied return on every single property in this category each and every time. So whether it's the Detroit property or the Florida property.
1,000,000%. I don't know. The projects do get me excited. I see I see added value. That's what I see. And
Yeah.
we all could relate. We've all booked a hotel before where the pictures look so beautiful, and then you get there and you're like, they must have had some extra HDR on this camera.
Yeah. No, it's very true. And then look, now we're looking at a California property for 800,000. So it's strange. We're in the same country, shift one state over, and now we're talking $1 million properties, and then you go 50 miles west or east, and it changes. So very
Sometimes it's a matter of a
important.
block.
Yeah. No,
It really
in
is.
Brooklyn and your neighborhood, it's very true.
Very true. How far are you from this location? Are you closer to here? Are you on the right side of the block versus the left side of the block where there's more traffic? Are you in a more noisy neighborhood? Every little thing can matter. And that's why I say know your market. And that's why, like I said earlier, that's why people generally like to invest in places that they know, that they understand. When they're looking at a property, they're like, would I rather live here than where I am right now? What does that look like? What's the differences? They can truly, number one, understand the value of the property that they're buying and be able to put a value to it. And again, don't just do that on your own. Your realtor is going to know more. Your realtor is going to be able to help you with that because they're talking to the buyers in the market. But you're already educated enough to understand where you would see a deal and you would see it where it's not a deal.
Yeah. And this is a very attractive property, and I'm looking in the background, we see the ocean, so it's obviously in California, right near the beach, and it costs more. So uh, don't it's like a menu. Do you order off of the left side of the menu and go for what you're looking for and what you want, or are you looking on the right side of the menu and ordering off of price? And so recognize that there's this back and forth between each one, and just because it's California doesn't make it great or not great. And there are certain states that have uh, laws that are more friendly to a landowner than other states, and so Max can talk to you about that. But and that's a really important consideration. When the pandemic hit, there were certain states that allowed you to continue to collect rents, and others maybe placed a pause on that. And so if you're needing the cash flow to finance the investment, it is good to know a little bit more about what that state looks like. Is it an attractive state? I know I live in Dallas, Texas, and Texas is a good state for landowners.
Texas is a very good state for landowners. New York, on the other hand, a lot tougher. There's definitely a lot more, it's definitely a lot more tenant friendly than it is landlord friendly. Um,
Yeah.
Getting to know that is super important as well. Knowing what your rights are essentially, how does it work? Um, and that's where part of your team, you should also have a real estate attorney, and your real estate attorney is probably going to be more your closing attorney, right? They're going to be the one that helps you finalize the transaction, put the contract together. But guess what? If you ever need somebody, they're going to be the one that you talk to get you over to an eviction attorney or somebody that could help you with any problems that may arise. So your network has a network, right? Go out there and network, build a team, build people that, are informed and, really truly are involved in real estate. Other investors, right? They're going to be a great resource as well. They're going through a lot of the same things you're going through. So, hey, by the way, check out this contractor I just used. Why don't you give him a try? Right? That's how these conversations go. And that's where most of my network has come from.
Max,
Um,
maybe we have a few minutes for you to share just what the investment calculator could look like for different types of loans. And I think people would like to see kind of how it works, because we've shown them the properties and the different
Absolutely.
types of properties.
Absolutely. And I want to remind everybody also, by the way, we want this to be interactive. We want to hear your questions also. If we get a chance to, we'd love to answer some of them. So if you do have any, feel free to put it in the comment section. And if we don't get around to it today, we'll make sure that we put out content that is going to be guided for you and make sure that the next webinar maybe has more information based off of what you're looking for. But if anybody is looking to be able to calculate a deal and want to see what profitability looks like or what their DSCR could come out to, if you go to expresscapitalfinancing.com, you're going to see right over here, you're going to see deal calculators, and we have a fix and flip calculator, which could be used really for any type of bridge loan. It could even be used for new construction. And then you have your DSCR calculator, which again also could be used for any type of rental property, whether it's 1 unit or 20 units, you could use it the same way. So really quickly, I'm going to take us through into the fix and flip calculator where I can go down here, put in my property address. I'll set in the purchase price. I'm looking to buy this property for $100,000. I'm looking to invest 50,000 in the renovations. And let's just say we're hoping to come out with a 215 after repair value. I'm assuming it's going to take me about 7 months to flip the deal because maybe properties don't sell as quickly, but I know I could get the renovation done in 4 months. I'm going to add an extra 3 months for my sale time. Now, any of this information, your loan information that you're unfamiliar with, you can feel free to call us directly at 718-285-0806. We'll have a loan officer that'll qualify you and help you know what it is that you do qualify for. So an initial conversation is always helpful so that you're not guesstimating and putting in, information that may be irrelevant. But let's just say over here, we're looking to get 90% leverage on the purchase. We're going to do 100% of the renovations. I spoke with my lender and their legal fee is, $1,000. The interest rate I got approved for was 10.5%, and there's a 14.95 underwriting fee. And again, by the way, I'm including everything because most people, when they look at a deal, they look at it from a very gross perspective. Buying the property for 100, spending 50,000 on renovations. I'm going to sell it for 200. I made $50,000. Everyone forgets about your closing cost to buy the property. They forget about the closing cost to sell the property, and they forget about the holding cost when you're actually holding onto the property. So it's not as simple math as that, and that's why we've built this calculator out so people are able to utilize this. Now, if you're not sure, hey, does my state have mortgage tax? You can really quickly go and say, hey, does Texas have mortgage recording tax? And it'll tell you it does not. Great. There's no mortgage recording tax here. I could put down a zero. Title insurance, a little bit trickier. I typically like to use 1%. It does range based off of where you are. Title insurance is also something that's a very mandated cost. So it's not like one title is going to charge more than the other. If there is, it's usually a little bit of the fees that they may have, but the actual policy is mandated. If you have transfer tax, I know that here we have a 2%. Actually, I think we have a 2% mortgage tax and a 1% transfer tax, if I'm not mistaken. Your property taxes and your HOA fees, it's going to cost you, let's say $2,200 a year in taxes. And there's no mansion tax. Mansion tax is when you're selling a property over a certain dollar amount and every state has a different dollar amount. So once you surpass a dollar amount, it's a mansion, and there would be a tax on mansions. Um, what's your personal attorney's fee to close the actual transaction? What are you going to have to pay your realtor to sell the property for you? Maybe they're charging 6. Maybe you got a deal at 3. I like to use 4 as a middle number just to start off with. My appraisal cost, and then throw this in real quick. We'll make sure I'm a real person. And just like that, now I'm going to have a full report that's also going to get emailed to me about everything that I just put in there. It's going to show me my acquisition cost, and it's going to break it down for me. So now that $100,000 purchase price really turned into 111,240. My holding costs, including my renovation budget, my how much is it going to cost me for interest payments? And again, we use max potential because we don't even charge you interest on the full 50,000 until you start using it. So it's going to assume the worst in that scenario, which is what I would recommend. As a professional, we always plan for the worst and hope for the best. How much draws might cost you, property taxes. Great. My interim cost is now 61,858. What about selling my property? It's going to cost me another $12,000 to sell my property. And just like that, now it's going to break down my ARLTV. It's going to tell me what percentage of the loan, what percentage of the after repair value is the loan. What percentage of the entire deal what percentage of my loan is the entire cost of the deal? So you realize over here that even though we're lending 90% and 100, you're really getting 93% of the entire project cost, right? So you only have about less than 7% in the entire deal. And what it comes down to show you is, hey, this is how much you would need to close on the property. We even try to estimate the third party closing costs for you, right? Now, again, these are not factual numbers. That's why I was saying earlier, depending on how well you put your numbers in, is how good these calculations are going to be, right? The same way a calculator is. So try to get, as close to these numbers as possible. If you need to reach out to your title company or your attorney and ask them what the costs are on their side, use those numbers so that you have real figures. And just like that, now you have what we would recommend even as liquidity. Just because you need $21,000 to close, remember, just because I could buy it and go purchase broke doesn't mean I should. So I want to make sure I have enough money to get started with renovations. I want to make sure that I have enough money to be able to afford a couple of months of interest payments. So this is what we would like to, this is what I would recommend that you have. And based off of this now, it's going to show you, hey, I'm going to make 90% cash on cash return. That's fantastic. That's a great
Yep.
deal. I'm going to make $30,000 on $21,000 that I've invested into the project, right? So this is where it's funny. We just did a session on that the other day also, the difference between return on investment and cash on cash. A lot of realtors, when they're selling properties or even investors in general, they'll talk about an ROI on the property. And they do that because everybody has a different, method of financing, different costs behind the transaction. So they can't really tell you what your cash on cash is. Only you could tell you what your cash on cash is. So they use a term called ROI or other, AKA cap rate. A cap rate is just the return, the gross return over the gross purchase price. So that doesn't really tell me how much my money is making for me. Your cash on cash return is how much money you made over the amount of money that it actually costed you to do the deal. So after all is said and done, after all my expenses, I made $29,000, $29,906. It costed me $21,000 to do the deal. So I could see a great return on my investment. Now, again, we're also accounting for the reason that that math is not adding up is because we're also accounting for the cost of interest payments built into it, which is not in the cash to close. So we're looking at the total amount of money that you've actually had in the deal at that time, which is 33,000. So we're taking the full number of how much you have actually sunk into the deal. Um, we also, very similarly, we have a DSCR calculator. It's going to help you pretty much exact same thing, but just with different information. Um, I'm not going to go through the full one of this one, but just to show you the differences here. Here I can choose whether to purchase or refinance. I'm buying it for 150. Now let's say I'm buying a 3-unit property. So now when it asks me what my leverage is, I got a offer of 6.9875, 30-year amortization, and I don't know, let's say there was $2,500 in closing fees. And now it's going to ask you for the rental income for each unit. And it's going to say, okay, well, unit one, I could get, uh, I did a small number, so I'm not going to go anything extravagant. We'll say I could get 750, and this one over here I could get 500, and this one over here I could get 675. And if you know your vacancy rate, plug it in. Again, usually the smaller unit properties don't have such high vacancies. You're usually getting them filled in pretty quickly, but it doesn't hurt to build in a buffer. Even at Express Capital, we don't use the vacancy rate when we're dealing with a 1 to 4 unit because we know that once it's vacant, you could put it on the market. In most markets, they will rent fairly quickly. You could fill in your property taxes, insurance cost. If there's an HOA fee, maybe it's $10 to $50 a month. If it's a condo, sometimes they could be a lot higher. And how much do you anticipate that you might need to spend in annual repairs and maintenance? Right. So, and this is per unit, right? So let's just say you say, okay, I'm going to allocate $100 per unit per year. This is what we want to see you doing. Even though when we underwrite it, we're just building that into our buffer of the 20% that we want to see you have in cash flow. Be a little bit more, conservative. Understand what you may need to do in that area. If you're renting out to college kids, expect that you are going to need to do repairs. They are not as clean and tidy as a family of three. Even though the family of three has kids, you have to think of all these things and put that into place. The more you plan it out, the more you think ahead, the much more profitable you will be. But I'm not going to go too far, down into it. It's the same exact process. You fill out the numbers. It'll ask you for each thing individually. It'll tell you even what to think about that you may not have thought about and help you calculate your entire deal, show you your profitability, your how much cash flow you'd be able to get out of the property, what your cash on cash return is. And to go back to a conversation we had in the beginning of this entire conversation, this is why we're seeing a lot more people choosing to buy investment properties over their primary home first because they're seeing how they can utilize their money better and still afford to pay that rent payment that they may be living in. And, I'm personally a big fan of that.
And Max, maybe you could spend, I know we've kind of gone time, but I would love to hear a little bit about what an ARV is and
Mm.
how an investor might use that as just a starting number to build out a strategy.
Yes. So your ARV is your after repair value, right? How much the property is going to be worth after the renovations are completed and it's in the condition that we're hoping for. Now, there is napkin math that you can use, right? So I don't know if you don't see my screen anymore. So, anyways, I'll open up a calculator real quick. And if let's just say my ARV is $300,000. Now, depending on who you are and what you're targeting, some investors will use the 70% rule, some will use the 75% rule, and some will use the 65% rule, right? That's what that is. The lower the number, the more of a margin you're going to have on your deal. So let me explain. So on 300,000, 65% of that is $195,000. Now, if I minus from there the cost of my renovation, let's say of 30,000, I now have 165,000, which should be my max purchase price or my max loan, you could even say, on that property. Um, Loan for the purchase, not entire value. That's now you can use the 70% rule. I like to use that as a good figure because you're building it in. But it's a quick math to see, hey, if I know this property is worth 300,000 and they're asking for $200,000 for this property, I can already tell you that I'm probably overbidding using the 65% rule. If I use, 500,000 and and I'm going to use the 70% rule, which is 350, and they're asking for $200,000 for this property, it needs $50,000 in renovations, that's probably a good deal, right?
Yeah.
And very quickly I could identify that to see this is the napkin math, the calculator is the actual math, right? We need to be able to identify and understand, what am I throwing out in my face? What do I not want to look at because it's not the right price for me? And what is in the right price? And then once I've identified something, hey, this is actually a decent deal, I could see right away quickly that it makes sense. Let me now do the real numbers and make sure that it's as profitable as I thought it was.
That was a great explanation. Um, and also a great starting point for just, a simple way to think about real estate when you're about to uh, uh, begin the process of what you're trying to do is make sure that your entry point supports additional value in your pocket at the moment you purchase it, period. And then what you choose to do next, which is you're you know you're going to you'll have options for financing up front, but then maybe you'll have longer term options. You'll have options for what you choose to repair or renovate, and then how what those choices really will mean. And then there have been times where at one point people always use the word kitchens and bathrooms, and I think that isn't where we are today. And so that landscape of where you allocate capital in a renovation changed, and so I would try to be smart and make smart choices to support adding value. So if you spend $1 on a renovation, I would want each dollar spent to produce a return. If you choose to go and let's just say get a stainless fancy refrigerator that costs X, you may find that that produces a negative return because it wasn't going to attract, additional purchase price on the disposition side. So each and every choice that gets made is impactful in a positive way or a negative way. And so it's important to make an informed decision of where the return could come from in fixing up that house.
1,000,000%. I can't tell you how many times we've seen people do extensive renovations on a property that doesn't need extensive renovations for the area they're in. They over renovate. And by doing that, they've
Yeah.
sunk too much money into a property that would never exceed a certain price point. They've meaning just to give you guys an example, I want, this is actually a really big pitfall that I want to make sure, right? A lot of people, they get into their first deal and we have this perfectionist mentality of doing the best renovations and everything as good as we can. And if you're in an area where the highest purchase price is 300,000 and you went in and sunk in more money to it thinking that you're going to get 350 or 400, and now the entire market's like, well, yeah, you built a really nice house, but that's not for us. No one's going to buy a $400,000 house in a $300,000 area, right? So know who you're catering to, know who your buyers are, know what the property could have needs in renovations before you do it, because you could under renovate or you could over renovate, and over renovation is usually the bigger problem that we see.
Yeah. And there's also a mentality that comes along, and there's two things I'd like to say. When I was growing up, I thought teachers were interested in what my thoughts were. I realized if I was interested in what the teacher thought, grades, went up. And so you may have personal preference for what a certain product is, or you like the stainless steel refrigerator, but someone else may not agree with you, and that person's opinion matters a lot because they are your buyer. And so you agree with yourself on your renovation style, but it's your buyer that you need to be thinking about because that's what counts. And next, a lot of people feel that they deserve to make a return. The market doesn't care if you make a return, and the market doesn't care that you bought the fancy stainless refrigerator. The market cares about what they think it's worth. And so if you purchased a refrigerator for, I don't know, what do they cost? $2,000. It doesn't, no one owes you $2,000 for that refrigerator at all. And that's true of every single thing you do to improve that house. It's it's not like somebody says, "Oh, you purchased it for this, you put $50,000 in, and so then it is worth, your purchase price 50,000 and your return." The buyers don't walk into the purchase of a property ever thinking that way, and they will not be asking you how much did you spend on renovation, and therefore I want to make sure you get a good return. That's not they Do they ever ask that question?
No,
No.
I've never heard that.
So because it
Otherwise, it would
doesn't
go the other
exist.
way around too. It'd
But
be like,
but
oh, well, you
every
only spent
person on
this
the
much.
but on the backside of every one of your clients is thinking along those lines because they
Yes.
know what they got in for, they know what it cost to carry it, and they know what they spent on fixing it up. And so they have a fixed number in mind, and then they're calculating their return based on that fixed number. And so make sure that the choices made to support that fixed number at the very end were good choices that produce a profit.
Don't be emotional. I think we went a decent amount over time. We hope that everybody was able to get good value out of this session. We'd love to hear any feedback, comments, or questions that you feel you'd like us to go into next time. We feel like this was a really good entry level information base of where to start, where to find your information, how to be able to calculate a deal and its returns. We want to be able to go into each session going in a little bit more a little bit higher in the level of the deals and be able to come up with more things, because as you get started, you're then going to be able to, just like anything else in life, you're going to grow, you're going to have to start finding more and more deals, and you're going to have to get more and more creative to making them. So we're hoping to be able to bring all the different information to you so that you guys can find the right properties, come up with the right strategies to be able to get in and exit it the best way possible. Any final
Absolutely.
comments on your side, Paul?
Well, I'll say that we're here to help in every way we can. I can be found on LinkedIn, and I know you can too, Max. And um, I would say if you think about yourself, think about the team that surrounds you to support you here. And don't be afraid to use an agent in helping you purchase a property on our platform. I think that that can be a very good, that's good, sound, sage advice. I think that that, especially because one house is a lot of houses, and you want to make sure that you're, making an informed decision and then working with Express to get the financing piece in place so that when you do bid on a property, you know what you're doing and you're walking in with a game plan.
And call us before you put the have the contract on the property, especially when it comes to an auction. Don't wait till the last minute. It's always best to have that conversation up front. We can inform you on what you qualify for, what a deal looks like, how it should look, and just guide you through the process. Like that's what we're here for. We've seen hundreds and probably thousands and thousands of deals at this point. Feel free to talk to us through it. We'll help you out. We'll give you the advice you need. We'll point you in the right direction to make sure that the deal works. You're going to be successful at it because we are all rooting for your success.
Yeah, we really are. And if you think about when someone goes to purchase a home to live in, they get pre-qualified. So that step is part of the process of going to purchase an investment process, property. So some of what you do to buy a property is the same, even though the mentality behind it is different. But anyway, we're here to support you. We want to see you succeed, and we're happy to help. Find me on LinkedIn at Paul Viguerie, work for Altisource and for Hubzu, and then Max with Express Capital. So we'd love to help.
It's always a pleasure. Paul, thank you so much for your insight. It's always been a pleasure.
Thank you. Everyone,
Take care, everybody.
thanks for joining us. Bye bye.